Now, the Bernard Madoff scandal story continues to evolve today. As we have been reporting, Madoff's alleged Ponzi scheme cost investors possibly $50 billion. Joining us for a discussion on just what went wrong, Charles Gradante, co-founder of the Hennessy Group and an advisor to hedge fund investors. Also joining us on the phone from his office in San Francisco, Jay Gould, partner at Pillsbury Winthrop Shaw Pittman. He's a former SEC attorney. Gentlemen, welcome to the show. Charles, let me just start with you to ask the question that so many people have been asking me. How does a guy pull off such a huge scheme for such a long period of time?
Well, I don't know exactly how he did it. I have a theory which is very plausible. Being a market maker, market makers typically are highly leveraged to capital. And I think somewhere along the line, he was taking overnight positions out of necessity because he couldn't lay off or sell off the other side of the position to somebody. And those positions created losses. And being levered, it doesn't take a whole lot of losing positions to wipe out your existing capital, which was probably his own money for real initially. But then once that was wiped out, he started dipping into the investment advisory side of the business. And how he went through $50 billion is the $64,000 question, but that's how a market maker can lose a lot of money. Once again, over-levered, lose money on positions overnight. Market makers are supposed to be zero exposed to the market overnight. He probably couldn't get hedged well enough, and then that caused losses, which then forced him to borrow money or take money out of.
But it's similar to, and then goes even beyond what Nick Leeson did at Barings.
Exactly. I would imagine we're going to find many phony client accounts where he buried the losses so that the real clients had a K1 that looked satisfactory, but he had phony clients that were never audited, and those clients had the losses.
Jay, let me ask you, how does this, the question of how it goes on, though, for so long and it's such a huge amount of money still remains to be answered, because a lot of people were pulling up red flags all the way back 9 years ago, at least. Why does the SEC not look into this and investigate more thoroughly?
Well, they did investigate at one point several years ago. Remember, Madoff was not a registered investment advisor until 2006, although that does not stop the SEC from going in and investigating when there are allegations of fraud. And here you had a registered broker-dealer with an investment advisory arm on the side, or an affiliate. And so certainly the SEC had the authority to go in and take a look at it. But a lot of times, in a situation like Madoff, he is regulated. His primary regulator was the NASD at that time. A lot of people who are successful get complained about to the regulators, and once the SEC went in there and didn't determine that there was a real problem, then he goes sort of lower down the priority scale. And somebody at that level, who's that well known in the business, once there's been an investigation and nothing found, they're not going to be high on the radar screen afterwards. Let
me ask you, we were just talking during the commercial with Charles about the possible lawsuits that arise out of this. Is the SEC one target of that?
The SEC a target of
possible lawsuits here?
What you're suggesting is that the SEC has been negligent in their job?
I'm asking.
Yeah, and I don't think that's, people can allege that, but that's not real. That's pretty much a non-starter. The lawsuits that you're going to see are lawsuits from people who lost money, and those lawsuits will go against the estate or what's left of it.
Which is probably very little, as far as we hear.
Yeah, again, the way these things start out, and I agree with Charles' plausibility scenario as to how this may have occurred, but people typically don't start out to develop a Ponzi scheme. What they do is they take in investor money, advisory clients, and they lose money, and they feel really bad about it because these were my trusted friends, and so they don't want to tell them they lost the money, so they bring money in from other people and start paying them. And by the way, I'm going to make that money back, so I'm going to stretch on some of my trades and lever up on my trades to make that money back. Keep losing.
Let me break in and ask Charles: is there any way these guys get their money back? Because we're hearing there's very little money left there.
No, there's no way that they'll get their money back. The bankruptcy committee will find very little left other than his estate. But I'd like to make 3 points on what needs to be done. First of all, I think hedge funds should have a fraud audit performed. That's a whole different type of audit than what investment advisors do. There's no way an investment advisor can do a fraud audit without getting into the books and records. So the SEC or the Congress can mandate that fraud audits be done. The investors pay for the fraud audit, like a Kroll's fraud audit, and Kroll's signs a confidentiality agreement to make the hedge fund happy, and they go in and do a complete wash of the books. Secondly, we should have monthly administrators getting the NAV. And thirdly, the accountants should be voted and picked by the limited partners, not by the money manager.
All right, Charles, excellent points. Thank you so much for joining us, Charles Gradante and Jay Gould. We take a quick break.